Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and today I'm just going to analyze the markets and talk about the macro moves. Alright, first of all, the dollar index did gap right below that, right down into that 79.50 area. I guess I missed it last night, but essentially what happens is that overnight, a lot of investors in the Eurozone and the European, I guess, the prop desks, the banks, they decided to liquidate their Euro-US dollars, and basically they decided to get rid of their euros. They took the Japanese yen and they continued to allocate their risk capital outside of their respective economic zone. So what's happening right now in Europe is that even though we're in a seasonal event where risk appetite is typically higher than it usually is because we're in earnings hype, that's a seasonal event, but right now we're getting conflicting signals from both the market, from the macro versus the seasonal factors right now. So again, we got macro factors where the Euro-Japanese yen is weakening, the Euro-US dollar is weakening, and therefore the dollar index is rallying. And when you pair the dollar index to the stock indexes, they tend to work in an inverse pattern. We got a topping hammer right now in place. I'm not exactly certain how these markets will exactly play out, because essentially what we're having is conflicting seasonal and macro signals, and that's really bad if you think about it, because what we're really trying to go for is an idea of where this trend is kind of going. And because we can't, or I've had a hard time really determining it, I decided to go for a market neutral hedge, which I'll talk about more later on in this video, and I'll discuss the specifics behind why this trade is going on. But essentially, the euro, the Italian 10-year bond yield has traded in a ranging pattern. It initially fell down to around 6.88, but it ended up at around 6.94% on the aftermarket trade. So essentially, bond investors continue to liquidate their European bonds, and they continue to buy into the Japanese Treasury bond market, and that's just really driving what's driving the Euro-US dollar and the Euro-Japanese yen now down. Now, I was thinking perhaps we had a possibility of breaking out of this channel, considering the seasonal factors, but the macro factors eventually won out. We weren't able to sustain above this trend line, and we just got pushed under that 20-day moving average. I believe it's a 20-day moving average, but I could be wrong. Yes, it is the 20-day moving average. We got pushed right under that 20-day moving average and the top end of that channel. So again, this is just typical market behavior. I honestly thought the seasonal factors where risk appetite is typically higher than it usually is was going to be enough to break us out of the channel. I was wrong. Again, this is just typical market behavior. Nothing you can really do about it as an analyst. You kind of, assess your mistakes, you determine where you've done wrong, and then you kind of patch it over, decide, what's your plan of action. And right now I'm deciding to go market neutral. So let's move on to the next chart, which is the Euro-Japanese yen. This was a chart I was more convinced that was in a really strong downwards trend. We've seen the Euro-US dollar continue to move in a downwards pattern for the past 5 years. Ever since the beginning of 2007 was where the market started pulling back. They wanted a safer asset class, and I guess the European bankers decided to settle on Japan. Japan has a really, really large bond market, almost equivalent to size to the U.S. Treasury market. And since we're working with economics of scale, if you manage a multi-billion-dollar bond portfolio, the only market you really have between Europe, the United States, or between the G20, when you represent a major economic bloc and you need to shift your assets out of it, you have to shift it into a different economic bloc. And right now, people have settled for the Japanese yen. I've been mentioning this time and time again. I believe this downtrend is there to hold. I think this is going to continue to work out throughout the 2012. And the people that will benefit the most are going to be the currency speculators and the bond investors that buy into the Japanese Treasury bond. Of course, the losers will have to be the European and Japanese populace. Main reason being is that the Japanese will become less competitive from an export standpoint, and even though the Europeans may become more competitive from an exporting standpoint because of the fact that their goods become cheaper, and that gives you a marginal benefit, the only problem though is that since the government has overextended credit, it's dealing with a deflationary cycle right now. Government spending is being cut back. When you cut back government spending, public sector jobs are cut. When you cut public sector jobs, That causes economic contraction, and since it's such a huge portion of the economy relied on economic stimulus from the government, once that public sector spending is cut back, their deficit spending is no longer there to support an economy, what typically happens is that the economy has to regress, it has to reassess where it truly stands, and that's going to take some time. The public sector will really get hurt, but the private sector will also get damaged, and that in turn will lead to a money contracting effect because banks will lend less money, mortgages, people will be behind on their payments, public sector employees will have to find private sector jobs, and really the whole entire economy has to reallocate itself and basically push itself out of non-productive areas and push itself into more productive areas. And that kind of goes into Hayek's economic theory and less of Keynesian, but they're both very valid if you think about it because they address different areas and different thought processes. And again, a true market analyst has to consider both conflicting theories of economics and really side with what's going to apply based on the different case scenarios. And you're not always right, and what eventually proves you wrong is the markets. So I'm not always right, but I do believe that I'm right enough to be worth heard out at least. So again, I think I get it on the mark enough to make it worthwhile for you guys to listen to my videos. Again, let's move on to the next chart, which is silver. Silver, I went into the silver short, I went long silver, I got crushed. I bought in towards the end of the silver session. I'll go ahead and kind of point this out to you. What happened on Tuesday was I was kind of excited. I went on Tuesday where market behavior was really positive at 4 p.m. We're trading at around 29.50. We go into the next day session at 10 a.m. We pull back to 29.20. Since the markets were moving in a very positive direction, I lost around 1% of my portfolio to the AGQ. Again, I was going long a leveraged silver ETF. Didn't work out too well. I decided to cut my losses real quick. I wasn't sure of the macro factors versus the seasonal factors because, again, if the dollar decides to strengthen, we'll go back to the dollar chart real quick. If the US dollar index continues to strengthen, and since silver is paired directly to the dollar, what's going to happen typically is a strong dollar is going to lead to a weak silver market. And the main reason why we're getting a strong dollar right now is the markets are sending a signal. European bankers continue to allocate assets outside of the European bloc into different economic blocs, mainly the United States and Japan. Perhaps there are other smaller blocs, but since they don't operate on economics of scale that meets the criteria of these bankers, they're going to typically go for these bigger blocs like China, Japan, United States, places like that. So again, we're kind of reallocating assets right now, and I don't think that I think my expectations on reflation in the silver chart could be wrong. I do know for a fact that we kind of broke out of this trend line right here a little bit, maybe not too much. I could be fooled, and we still have a topping pattern towards the 20-day moving average, which doesn't make me feel very comfortable. Again, there's always room for error when you analyze markets, and I'd much rather play on the safer side right now. So what I decided to do was I decided to go short both the daily financial FAS, which is the daily financial bull, and I also decided to go short the daily financial bear. So and really how this trade sets up is that it's a market neutral hedge. If the financial bear goes up, it's because the market's pulled back, but I'm still short. So again, if it goes up, that's because the market's pulled back. If it goes down, that's because the market's rallied. I'm still short. And again, the daily financial bull, how this works is that if it goes up, my short loses money. If it goes down, my short makes money. Either way, it's a market neutral hedge. It's a directional bias of a directional bias. It's a hedge that kind of cancels each other out. What the real selling point is that over time, these assets tend to decay in value. So we're going to look at a longer-term chart. We're going to see how much they decay in value. It hasn't really returned much value to investors. So if you held onto these assets for a really long period of time, we zoom back to inception at around 2008, where the daily financial bears, they're really expensive. They pulled back. They continued to dilute shares. They reissue different shares and stuff like that. But essentially, these assets like to decay in value over time. We see that even over a course of a one-year period, both assets tend to decay over time. So you see, so if I'm short both of them, it really wouldn't matter if the markets were to move in either direction over the short term. I'd be hedged on both the upside and the downside. And over the long term, since I'm both short, the daily financial FAS and the daily financial FAZ, my short-term portfolio will make money over the longer term as well. Of course, I'm only doing this for the short term so I can figure out the direction of the market and make a judgment, but since we're dealing with both seasonal and macro factors that are conflicting with one another, I have to be a directional, I have to have a zero basis, a zero bias. The best way to do that is to go both short the FAS and the FAZ. Moving on, I'm going to talk about Decker's Outdoor because it's going to be the last chart we talk about, but the Decker's Outdoor is a stock I thought, hey, this stock hasn't really been impacted by the risk appetite that typically comes into earnings season, but again, we're dealing with conflicting factors. I decided to go with a much more neutral hedge that kind of hedges each other and cancels each other out, but over time it produces yield because of time decay. But I decided to do that just because I wanted to assess where this market was going to go on a macro basis. I lost some money, so I'm just going to earn it back in a systematic way. But as far as Decker's Outdoor was concerned, I was convinced that this would bounce off of 76. It did. It gapped above, and it has actually been able to engulf two previous candles. We've engulfed one, two candle. We've engulfed two candles. We haven't been able to engulf another candle, but I'm anticipating us to trade between an $85 and $95 range between the two respective gap fills right here. So again, that's your target exit zone. I'm not going to participate in the trade, mainly because I want to hedge my macro basis on both the up and downside, and I'm just going to have a 50-50% allocation in my short-term portfolio, even though I have longer-term investments in my dividend reinvestment portfolio. So again, that does it for today. If you have any questions, leave a comment right below. I think I've answered, and if you guys have any questions, again, you can even inbox me as well. So take care, folks. I hope you guys have a wonderful trading session on Thursday, and let's try to make some money in this very volatile environment. Take care, guys.